PayPal has been by far the most disappointing stock in this market. The stock is down 59% over the last 5 years. It's been a disaster for the company, really, really bad. The stock used to trade as high as 66 times forward earnings. It's now trading at 13 times earnings. So it was a combination of some slowing revenue growth, but also a massive multiple contraction. And it's just been ugly for a lot of PayPal shareholders that have been covering the stock for a while. The company definitely has some concerns. Revenue growth has been declining from 9.4% to 8% to 5% to 4% to only 1.2% revenue growth. So there's a lot of things going on, a lot of things that I have to talk about. I'm going to let you know, guys, if I still believe PayPal is presenting some kind of an opportunity in this market, or if PayPal maybe is turning into some kind of a value trap and maybe we should avoid it. So I really hope you enjoyed this video as always. Now, looking at the last report, revenue was around 1% or 2% on a FX neutral basis, adjusting for currencies. Now, strangely enough, transaction margin was around 7%. Earnings per share, non-GAAP earnings per share growth, 23%. So why are margins and earnings per share growing so much faster than revenues? This is mainly because the CEO mentioned that he's focusing on profitable growth. He's not focusing on growing top line at any price. He's focusing on profitable growth, and he's focusing on eliminating less profitable aspects of the business. For example, they have an aspect of the business called Braintree, and Braintree is some kind of a non-branded checkout services that they offer, and they have contracts where they have very tiny margins, and it's not too profitable for them. And he's been trying to renegotiate a lot of the Braintree contracts, which he did mention is going to put pressure on revenue growth into 2025, but it's going to help increase profitability in 2025. But 2026, on a comparable basis to 2025, it should be much, much better in terms of revenue growth. So revenue growth is decelerating, and this is a concern. And the CEO is working on it, and we can see the improvement in margins and in the earnings per share growth. But we have to wait and see until pretty much 2026. So if I was a PayPal shareholder, I would give the company until Q1, Q2 of 2026. If I don't see the trend pick up by next year in terms of growth, I would consider exiting the company, because if it wanted to start growing again and play out, it would have done it already by now if it was really a one-time problem. But based on what the CEO is saying, it is a one-time issue as they're focused on profitable growth. And if we look at margins and other kind of things, we can really see that the CEO, he's not lying to us, and he's doing it the right way, and it's been working well so far. Now, if we look at the bigger picture with PayPal, total payments volume have been increasing every single quarter. This is not something that you see with a dying company. If a company is really dying, and if there's so much competition, which I'm not saying there's no competition, there's massive competition from Cash App, massive competition from even cryptocurrencies, and there's so many different competitors in the payment space. But even with all those competitors, PayPal is still growing decently well in terms of total payment volumes every single quarter. Once you start seeing payment volumes decline on a quarterly basis, then you could say that this is a business that has peaked, and maybe the best is behind us, and it's going to be downhill from here. But this has not happened so far. It has mainly been the sentiment of retail investors, because the stock hasn't really moved. But in terms of the fundamentals, this has clearly not been the case. If we look at the total active accounts, again, total active accounts have been increasing by about 2 million accounts every single quarter. Every 3 months, 2 million new people, they're being added to the PayPal platforms. They're signing up for PayPal, and they have been using PayPal. Over 436 million people are using PayPal worldwide. And this is, again, not a sign of a dying company. And by the way, I'm using Fiscal.AI to come up with all those charts. If you want to try it out, they give you free access if you want to use my link in the description. But looking at Venmo, which is a very important part of the business, and this is the fastest growing segment of the PayPal business in general, it's been growing 10% and has actually reaccelerated because in Q1 of 2024, it was growing 8%. Now it's growing 10%. So the growth at Venmo has been accelerating, and this is really good for the company. It's very good to see. And this is a very important part of their business, especially amongst the younger generation. Now, very recently, PayPal has gone down, I believe, around 6% on the day. And it was mainly because JP Morgan has decided to start charging fintechs for customer data access. So basically, I believe whenever a lot of people link their JP Morgan account to their PayPal account and PayPal wants access to the information of JP Morgan accounts, they're going to have to charge them to access the data of those accounts. I believe that's what it is. But PayPal went down on the news. XYZ, which used to be Block, which used to be Square, which used to be some kind of other name, it has gone down 4%. And other kind of companies have also gone down. Robinhood went down, Coinbase went down. And I believe they're trying to charge for data, which could potentially put some margin on the PayPal business model. But I don't believe it deserves a 6% pullback in one day on the company. Now, if we look at the company's guidance, they are still guiding $6 to $7 billion in free cash flow, $6 billion in share repurchases, and around $1 billion in capital expenditures. So $6 to $7 billion of free cash flow. This is actually pretty amazing. Last year it was $5 billion. Now it's $6 to $7 billion. Again, I'm very, very impressed from the company. Now, to calculate the free cash flow yield, I'm going to look at the free cash flow, and I'm going to take out the stock-based compensation, because as you guys know, stock-based compensation gets added back to the cash from operations, which is used to calculate free cash flow. Yes, PayPal did fix the metric in their GAAP metric, but in terms of calculating free cash flow, they're always going to add back stock-based compensation into operating cash flow. So for us to get the actual free cash flow yield that they can use to buy back stock, we have to adjust for stock-based compensation. So the last 12 months, stock-based compensation was $1.1 billion. We take the free cash flow estimate of $7 billion. This is around $5.9 billion of free cash flow that the company can use every single year to buy back stock. The current market cap is around $69 billion. I already made the calculations to keep the video short. It would make up around an 8% free cash flow yield. So in other words, at an 8% free cash flow yield, PayPal has no dividends. PayPal has very little debt. PayPal can buy back 8% of the market cap every single year if PayPal decides to do so. And this is pretty amazing from a company like PayPal. And this is their guidance. Their guidance is actually $6 billion, which if they get $7 billion, we take $1 billion out of stock-based compensation. That means PayPal this year will likely buy back 7 to 8% of shares outstanding. We're talking about insane kind of value creation for shareholders, especially at the valuation of an 8% free cash flow yield or around 13 times earnings. That isn't due to some major problem with PayPal, but is due to a temporary transition out of unprofitable growth into profitable growth, which is going to end next year. So this is going to create massive value for shareholders. If next year growth picks up again and the multiple expands for PayPal, it's going to be very beautiful. And PayPal has been accelerating their buyback program. As you could look on this chart, its shares outstanding have been sharply going down from, I believe, 1.1 million shares, now 999, and they've been going down. And this is very encouraging to see. Now, if I had to, you could say, estimate the potential return of PayPal over the long term, I would take the 8% free cash flow yield from PayPal as a basis. And on top of this basis, I would take what I would believe PayPal will likely grow in terms of revenues. So for PayPal, they used to grow a lot in revenues. I don't believe the revenue growth is ever going to get back to where it used to be before. And before that, PayPal used to grow in revenues like 18, 20, 22%. It used to grow a lot. And I don't think we're going back over there. But over the last few years, PayPal has grown in revenues around 8%, 8%, 6%, 4%. Next year is expected to pick back to 6%. So if they grow 6% in revenues over the next 5 years. And we have an 8% free cash flow yield. If all margins stay the same, if everything stays the same, I would expect around the 14 to 15% of value or annual return every single year with a company like PayPal. And this is excluding any multiple expansion from this price. And I would believe that would actually be an amazing return in the stock markets that we have today, which I believe is a little bit expensive. Now, the biggest mistake that a lot of investors are making is they believe that PayPal needs massive revenue growth for the company to actually be, for the stock to go up or for the stock to be profitable. But this is not the case. I said it before, but I believe PayPal is turning into like the next AutoZone or the next Cannibal. This is something that Charlie Munger calls Cannibal. And Cannibal is a company that buys back a lot of stock every single year, but for long periods of time. It cannot be 1, 2, or 3 years. Even though they have very slow revenue growth, like AutoZone grows revenue is 5% a year, 4%, 6%. The stock is up tens of thousands of percent over the long term, and they have created massive value for shareholders. Now, AutoZone is still buying back stock, but they're buying back stock at, you could say, I believe, 22 times earnings. PayPal is buying at 13 times earnings. So PayPal over the long term could even create more value for shareholders for AutoZone as long as the business does not decline, as long as they can keep some kind of growth, they can keep buying back stock 7 to 8%. In the next few years, I think a lot of magic will happen, and something like AutoZone could happen, or even something like Home Depot. Home Depot also does not have the best revenue growth ever, but the company buys back so much stock, where they bought back 50% of shares outstanding between 1994 and 2024, and that has caused earnings per share to grow like 8,294%. I'm not saying they did not have revenue growth, but they did not have crazy revenue growth like NVIDIA kind of revenue growth. They just had decent growth and some buybacks. And over the long term, and Charlie Munger talks about this, those cannibals, it's just magical. It's hard to quantify with a number, but some magic tends to happen. And I believe this is what PayPal is turning into over the next few years. And the longer PayPal stays at those levels, the longer PayPal stays at this valuation, the more they can buy back, the more they can return value to you as a shareholder, as long as we're right on the decelerating growth being temporary and not permanent. It should reverse by early next year. If it doesn't, then you have to reconsider your thesis on PayPal. But this is my thesis on PayPal and my analysis for today. As a lot of you have asked me about it, that's just my opinion, not financial advice. I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.